Hey everybody, it's happy St. Patrick's Day, Friday, the 17th of March. I've got my St. Patrick's tie on. I'm ready. I hope you are too. Man, what a crazy week it's been, and it's going to be another crazy week next week. So I'm going to talk to you about what I think is going to happen with the Fed next week. I'm going to talk about what's going on with the banking crisis and some similarities and some differences of what happened in 2008 as we saw the banking issues happening back then that created a major global issue. Then we're going to talk about the new program, the California Dream for All program, and how it really is going to be an amazing way to help people to purchase homes in California. So here we go. First of all, the banking crisis. What the heck is going on? My video last week talked a little bit about it because that was first when SVP Bank was collapsing and had been taken over by the FDIC. Then over the weekend, we find out that another bank goes down and the FDIC decided, hey, we're going to cover everybody's deposits no matter what. And there's a lot in there that I want to unpack. The first thing is we also have other banks right now that are having some major concerns. Credit Suisse, Republic Bank. Here's really what's going on. This isn't a problem with the overall banking industry. It's a problem with a couple of things. It's a problem with banks that have fewer depositors with bigger amounts of deposits. Because when you have fewer depositors that each have a bigger amount of deposits, when 1 or 2 or 3% of those people say, I need to pull my money out, well, that's going to create a major issue for that bank. Now, it's about worries on Wall Street that those banks are going to have the same problem as Silicon Valley Bank did. And the government last weekend basically said, hey, we're not going to protect the bank or the shareholders anymore. We're only going to protect the depositors. So if we go back to 2008, when we had the issues with, maybe it was 07, we had the issues with Bear Stearns collapsing. We had the issue with Wachovia going under and being sold. We had lots of banks that were collapsing. Couple of things to remember here. First of all, the banks were then, after we had a couple of banks collapse, the Federal Reserve stepped in and they started saving the banks. They pulled out TARP money, Troubled Asset Relief Program. Remember that word, troubled asset relief program. Because what they were focused on was the troubled assets, what the banks were invested in. That's exactly what happened with Silicon Valley Bank last weekend. They had troubled assets. They had mortgage bonds and treasury bonds that they had invested in that were worth a whole lot less today than what they bought them for, yet they were still claiming they were worth a lot of money on their balance sheet. That's a troubled asset. The difference now is that the federal government is saying, that's your problem. You guys bought troubled assets. Now, they weren't troubled when they bought them. But the truth is, look, the market goes up, the market goes down. You got to prepare for that. So it is the bank's fault for not being prepared appropriately. But the government says, I'm not protecting you anymore. I'm not protecting the shareholders. I'm not protecting the CEO and the president and the board of the banks. We're going to protect the depositors. So now that's actually created a big fear in Wall Street's eyes that said, man, I'm investing in banks. Any Wall Street investor says, if I'm invested in any bank, I'm concerned that that bank might have troubled assets. That bank might go under, and I'm not a depositor. I'm a shareholder. I'm an owner of the company, and I'm going to lose everything that I've invested in that. So let's pull out quickly. It's creating issues that honestly, I think we're going to see some more banks go down. What you saw back, in 2007, 2008 was you saw weekends be critical to the Federal Reserve because banks are typically shut down over a weekend and they merge with another bank. Their assets are moved to another bank. And we saw 2 or 3 weekends in September. Gosh, I feel like it was September of 07. Maybe it was September of 08. Anyway, that September, we saw 2 or 3 weekends in a row that the Federal Reserve was coming out with new announcements of new programs, saving new banks, issuing new proclamations. Well, guess what? Last weekend, they came out with some stuff. I wouldn't be surprised if this weekend they come out with more stuff because there's more banks that are having concerns, not just in the United States, but globally. Now, what does that mean to next week in the Federal Reserve, and what does it mean to mortgage rates? Well, here's the deal. There's an adage that says the Fed will raise interest rates until something breaks. Guess what? Something broke. They broke the banking industry. So the Fed basically, as I've been telling you all along, if you've been listening to any of my videos, the Fed has had to be the mom and dad threatening the kids saying, if you're not good, we're not going to Disneyland next week. knowing full well that you paid for the trip to Disneyland, you're going to take the kids to Disneyland no matter what. And they can't tell the kids that though. Well, the Fed's kind of been the same way because the Fed, I believe, knows what myself and people way smarter than I am believe, that the inflation issue is under control. By raising rates so quickly in the beginning, they did their job and they got inflation under control, but they can't tell us that. Because if they tell us, hey, we're good, we're out of the woods, then we're going to start acting like inflation's not a problem, which is going to cause inflation. But now the Fed has someone else to blame. Now the Fed has a third party that they can say, hey, this is why you guys shouldn't think you're out of the woods. And it's the banking crisis. So the Fed is allowed now to back off and say, you know what? Yeah, guys, I'm on your side. I think inflation's under control, but you better not go crazy because we got some economic problems that mean that the economy is not in good shape. What they were looking for was a job loss recession. In other words, a recession, a drop in the gross domestic product combined with job losses, or something they could blame for or hold accountable for why people shouldn't go out spending money like drunken sailors. They have that now. They've broken the banking industry. I expect next week, I think they're not going to raise rates at all. Honestly, they can't. In this environment, if they raise rates more, they're creating a bigger problem with the crisis in banking because those troubled assets are deeper in trouble. The more the Fed raises rates, the bigger trouble those assets are in. And so the Fed has no choice but to stop raising interest rates. And I had an analogy I came up with yesterday. I like it. I hope you do too. And it's kind of, like if you're a parent and you've been threatening your kids all along and saying, hey, don't do this, and they do it. And so finally you call a friend who's in the police department and you say, hey, you need to come over here and scare my kid for me. And so the cop comes in and tells them, hey, you're going to go to probation, to juvenile hall if you keep doing this kind of stuff, and really give them the third degree. Guess what? The parent now can kind of sit back and the kid says, hey, mom and dad, I think you were right. I think I need to be good now because, this third party, this cop is telling me I'm going to get in trouble. Well, that's the Fed being our parents all along for the last year saying, inflation's a big problem. You got to stop doing all these things. Well, now they have the banking crisis, which is that police officer that came in and they can back off. They don't have to raise interest rates as much. So that's kind of my 2 cents. What is that going to mean to mortgage rates? We've already seen them coming down. We've already seen mortgage rates moving down. Where they're going to go at this point, they're kind of as low as the Treasury moves faster than mortgage rates move down. So the Treasury's back down, 10-year Treasury's at 3.45%, which is about the lowest that it's been in the last 6 months. And when we've tested our lows, that's as low as it's gone, and then it's bounced back up. In January, it got there and it bounced back up. But in January, mortgage rates were in the high fives when the 10-year Treasury was at 3.43. Right now, they're in the mid sixes because as Treasury rates come down, mortgage rates come down slower. The question is, will the Treasury rate, the 10-year Treasury, go below 3.43, which says it's going to keep dragging mortgage rates down, and that's going to be good news. Finally, if you've had your head under a rock and you have not heard of the California Dream for All program, check out my video. I've got a whole channel on California Dream for All, and I'm really, really, really excited about this program. So there's a link down below in comments. Check it out. If you live in California, you're a first-time home buyer, you should be thinking about this program. By the way, you're a first-time home buyer if you haven't lived in a home that you owned for the last 3 years or living in a home owned by your spouse. Happy St. Patrick's, everybody. We'll talk to you soon. Bye-bye.